Hey guys, it's Realtor Christina Washington with the Homesfinder Realty Group, and today we're talking about money matters because money definitely matters. We're talking with a mortgage lender himself here in a second, Bruce Dorsey, about money because it's always a factor, whether you're buying, selling, renting, or investing in real estate. It's always a factor. It's one of the most important aspects of any real estate transaction. And I've found that it can be kind of a sensitive subject sometimes. You know, a lot of people don't really like talking about something so personal with a perfect stranger, and I get it. But there's a lot of misconceptions and misinformation out there, and it's not really something that's taught in schools about mortgages and how to buy a house and what goes into a down payment and closing costs and all of those important aspects. But it's also one of the first real estate questions that I ask when somebody comes to me and says, I want to buy a house. I said, great, wonderful. Now, how are we going to finance this transaction? So we're going to talk about some most common questions that we get when people come to us about real estate. But this is just a disclaimer. This is general information. If you want to know specific information about your specific situation, then it's always best to talk to a trusted lender. If you don't know someone, definitely reach out to a friend, family member, coworker, or your realtor and ask them if they have any suggestions for you, because it's important to get information that's pertinent to your exact situation. So Bruce, I know I mentioned this to you recently, but the reason I wanted to do this conversation with you is because I recently had a friend who is in a different city. She mentioned that she was ready to be a homeowner now. She's tired of renting, and she had gone to an open house, and she loved the house. She was ready to buy, and she said the house cost this much, and she divided that by 30 years or 360 months, and she realized that she could afford it. So I said, wait a minute, hold on. Let's pump the brakes for a second and talk about this. So let's get really basic here. What is a mortgage and how does it work?
So, and thank you. So a mortgage is going to be a synopsis or a payment for a particular house. And it's typically going to be a 30-year term. They do have different mortgage terms, 30-year, 15-year, 20-year, 10-year. And each payment, you're going to essentially be paying towards your principal of the house. There's going to be some other aspects of the mortgage as well, which will be your interest. You're going to typically have an escrow account in your mortgage, and an escrow account covers your property taxes, homeowners insurance, and in some cases, or most cases, mortgage insurance, which is called PMI. Which with each payment, you're going to be paying a little more principal as the term goes on. In the beginning of the term, you're going to be paying mostly interest. Again, when you typically have a 30-year term, you're going to be paying more interest per payment. But each payment going forward, you'll be paying a little more principal and a little bit less interest. So roughly 10, 15 years into a loan, you're probably paid all of the interest, roughly 15 years. And at that point, you'd be making mostly principal payments only. And of course, the escrow portion as well. So with each payment, you're going to be building equity into your house. Unlike a rent payment, when you're paying your landlord, you're just paying monthly payments, whether it be $1,000, $1,500, whatever the case may be. You are just making payments to them for that particular rental of their property or of the apartment. Where with a mortgage, with each payment, you're paying towards the ownership of your house.
Awesome. Thank you for that explanation. Okay, so we're talking about mortgage, we're talking about principal, interest. What are the current mortgage rates for a typical 30-year loan?
So that's a great question. Now is a great time to purchase a house, to refinance. The rates are at I say historic low. I've been in the industry for 15 years. I've never seen them this low. A 30-year fixed loan. Now, it does depend on the credit rating and the type of loan that you're doing, but I've seen them as low as 2.8 up to around 3.5% for a 30-year fixed loan. That's unheard of.
That's crazy. That's almost free money to buy a house.
It is. I mean, when you think inflation is 4%, a mortgage is less than inflation. So, yeah, you're coming up better buying a house and financing than to worry about inflation.
Okay, so we just talked about the interest rate. What is the difference between the interest rate and the annual percentage rate, or APR?
So that's a great question. So an interest rate is going to dictate what your monthly payments are, over the 30-year term or the term of the mortgage. And what an APR, or annual percentage rate, is going to let you know the cost associated with that loan. What that means is, if you're buying a house and you have, say, $5,000 worth of closing costs, that closing cost is factored into the APR. You take the interest rate, factor in the closing costs, and then you're going to have what is known as APR. So your interest rate may be 3.5%, and your APR may be 3.75. That's letting you know that that difference, which is 0.25%, is the closing cost in comparison to your interest rate.
Okay, great. Thank you for that explanation. So you mentioned that mortgage rates are at historical lows, and I'm sure most of us have heard about that, or hopefully. How long do you expect rates to be this low? I mean, if I've got somebody who might not be ready to buy now, but they want to buy and they want to take advantage of these rates, how long do you think they have to take advantage of these historical low rates?
Well, today's rate is really affected by a lot of the negative news in the country. In particular, right now, the coronavirus is affecting the interest rate. Historically, the rates are probably going to go up in the next 6 months, but they're still going to be at all-time lows, probably past the election. A lot of times when you have an election year, the interest rates are going to be low. We may see a fluctuation after the election, but until that happens, they're still going to be, in my opinion, at an all-time low, at least until we get past the election.
Awesome. So we've got a little bit of time to take advantage of those. So what does somebody need to qualify for a loan? There's a lot of, like I said, misconceptions out there about what they need. You've got, so many different factors concerning a loan and how to qualify. If somebody came to you today and said, "Hi, Bruce, I'd like to buy a house," what would you need from them?
So it starts with a conversation. We need to do an application, and an application with every lender is different. With our company, there's no charge, there's no commitment to do business with us, just letting you know where you stand. That application is going to be comprised of some goal questions, such as what type of house do you want, what type of mortgage payment do you want, how much down payment, what is your time frame. Then there's going to be some analytical questions. Who's your current employer? How long have you been there? What is your income, before taxes? What is your address? Of course, we do need to do a credit test, and that's typically going to be a tri-merge credit report. That's TransUnion, Equifax, and Experian. That's what is known as the tri-merge credit report. Those are going to be factors that once we have done a credit report, we've collected the information over the phone or face-to-face or online, the goal questions and also the analytical questions. At that point, you're going to have a brief synopsis of what you actually qualify for and also what the monthly payments would look like, for a particular purchase price on the house. So it's going to give you a blueprint of where you stand payment-wise, down payment-wise, how much house you qualify for, but there's some more steps.
So what are you going to tackle those steps in that first meeting, or is that something that you will get back to them about?
So, and that's a great question. So, the difference between, and then there's a difference between getting pre-qualified and getting a pre-approval. What we just talked about, the application over the phone, your goal questions. At that point, you're actually pre-qualified. At that point, you'll kind of have an idea of what you qualify for. At that point, you haven't, furnished any documentation to your lender, but you do have a brief idea of what you qualify for. So as long as everything that was, talked about over the phone or face to face is the same in paper or on documentation, then nothing's going to change. Now, getting a pre-approval is going to be the step that I recommend for all clients.
Me
and in
too.
fact, that's all that I do. I don't do any pre-qualifications. I do pre-approvals. So with getting a pre-approval, we're going to collect, we've done the initial application. We've done some of the questions. At this point, we're going over the numbers. And the next step is to collect financial documentation, pay stubs, tax returns for 2 years. That's going to be, depending on the loan, the 2017, 2018 tax returns. If you filed 19, then we'll use those instead of the 17. We're going to need W-2s for the most 2 recent years. We're going to need asset statements. Whether you're using a program or not, we're still going to need to get some asset statements because those programs do have different guidelines. And once we have all this documentation, we're then going to get an automated approval from that particular loan. And we'll go over the loan types in a little bit. We'll get an automated approval, and at that point, we'll be able to issue you an approval letter. And that approval letter lets you know that you're actually qualified for a particular house, a particular purchase price that fits your needs. And that's when you get into the hands of a realtor and start the home search. That's when you get in the hands of Christina Washington or whatever realtor you're using in the area. That's when you start the home search. And that pre-approval letter, if you haven't done all the steps that we just talked about, you want to make sure that you go through those steps. Because if you're not, then there's a good chance that you may go out and start looking at homes and find that you're actually not qualified when it gets to an underwriter. When you make an offer on a house and that offer is accepted and it goes into an underwriting department, if the lender has not done the due diligence up front, getting the documentation, getting the automated approval, going over the numbers, make sure they fit you. If they haven't done all of those due diligent parts and pieces, then you are putting yourself in jeopardy of losing, financials like a home inspection cost, earnest money deposit. Different things can come up where you can have a financial loss. And on top of that, you could actually have the heartbreaking loss of not getting the house.
Absolutely.
Which is a shame.
Yes, that is a very heartbreaking thing. It's something that I definitely require before we go out to look at a home. It's that pre-approval letter. Nobody wants to see their dream house and realize they've got 10 more steps to do before they can actually put in an offer. And then by that time, somebody else could have come in and gotten the house right from under you. So that's a great point. Okay, so you mentioned types of loans. What kind of loans are they going to get? Can they get out there to buy a house? What different options are there?
And so there are several types of loans out there, typically 4 main loans. There are some more loans, but I'm going to go over 4. There's going to be FHA, which is a Federal Housing Administration loan. There's going to be a conventional loan, which is backed by Fannie Mae and Freddie Mac. There's a VA loan, which is a Veterans Affairs loan, which is for veterans only. And finally, is going to be USDA, which is a rural home purchase. They each have different parameters to qualify for, depending on the client. Not everybody fits into each loan. Typically, an FHA loan is going to be your first-time home buyer, and it would also be a first-time home buyer who may not have excellent credit. They may have good credit, which may be about a 660 or below, will typically be an FHA borrower. If you have excellent credit, which is typically about a 680 or higher, then you're typically going to looking at a conventional loan. Now, the down payment for each of these loans is different as well. With an FHA loan, the Federal Housing Administration requires that you put 3.5% as a down payment. That's 3.5% of the purchase price of the house that you're going to need to put down. Where with the conventional, you can put down, depending on the credit rating, as low as 3%. So it's actually less than FHA. The typical myth throughout the industry, throughout the country, is that when you're doing a conventional loan, that you need to put 20% down. And that's not the truth. You only need 3%, depending on the credit rating. If you have, and then also the loan type, up to 5%, which is still not a lot of money to put down. Now, the other two loans that we talked about, Veterans Affairs and the USDA loan, requires a 0% down payment. There's an asterisk there. Down payment and closing costs are two different things. So to our viewers that are looking or will be watching, down payment is the money that you put down on the house. You find that if you get, for simple math, if you have a $100,000 house and you're putting $10,000 down, then you're financing $90,000 because you take $100,000 minus the $10,000 that you're putting down. Now let's say that you are doing 100% financing, which means no down payment, but you have $10,000 in closing costs. In this case, you're going to still have $10,000 in costs that you're paying, but you're financing $100,000 because you're not putting any money down. So the down payment is going to be the amount that you're putting down on the house, your immediate equity on the house. The closing cost is going to be the cost that you pay the third-party companies or providers in the transaction, which we can go over that in just a second.
Okay. Awesome. Okay. So we talked a little bit about this, but we're, PITI, it's something that I'm not a lender. So of course, again, if you need specific information for your case, talk to a lender, but it's something that I usually bring up. PITI, mixed up mortgage. Can you go over the specifics, PITI, what that means?
Yes. So PITI is principal, interest, taxes, and insurance. And it's called PITI. And it's going to be a part of pretty much every loan in the beginning of the process, FHA or conventional. You're going to have some form of mortgage insurance or PMI. And that's part of the escrow portion that we talked about in the beginning. With every loan, you're going to have principal and interest. And some loans, such as the VA loan, the Veterans Affairs loan, there is no mortgage insurance or PMI at all. But you're still going to have property taxes and homeowners insurance. So when you are looking at a house and you find a particular house, $300,000 or whatever the case may be, and you go to an online calculator and you plug in these numbers and try to figure out what your payment is going to be, you have to remember that there's also going to be your property taxes, your homeowner's insurance, and in most cases, mortgage insurance as well, which is PMI or MIP. Those are all going to be factors into your monthly output. So when you're looking at a house, factor in how much the property tax is going to be, because that's a big factor. And that's something that you'll know up front. Homeowners insurance, you typically have to estimate on how much that's going to be. For, say, a $300,000 house, homeowners insurance may be $100 a month. That's a safe estimate. But then you still have to figure out the last piece, and that's the mortgage insurance. And then in some cases, there is another cost. It's not part of the mortgage, but it's still part of your monthly output, and that would be if there's a homeowners association due. You have to factor that in, because even though it's not part of the mortgage, it's still something you have to pay every month.
Absolutely. Thank you for that. Okay, so we've got the PITI. We know what a mortgage is made up of. I want to buy a home. What are there any other costs that have to be considered when thinking about closing, going to the closing table, getting those keys, which is the part that everybody loves and wants to get to, are there any other costs that I need to consider before I get there?
Absolutely. So some of the third parties, and I'm going to go over some of the bigger third party costs in buying a house is, one, we have to set up an escrow account. So you're typically going to have money in your escrow account for property taxes and homeowners insurance. When you're buying a house, there's going to be a title company. That title company is going to record you buying the house. They're going to record it with the county and the state. They charge for it. It's not free. There's going to be a lender cost, and that ranges from lender to lender, what they charge. There's going to be an appraisal. A lot of times I recommend a home inspection. You definitely want to know the condition of the house, and that home inspection is going to let you know the condition of the house. Even if it's a brand new construction, I would still recommend a home inspection. If a builder is doing some shoddy work, you want to know that up front. An appraisal is going to let you know the value of the house. There's going to be normally a earnest money deposit. That's a good faith deposit that you are a serious buyer, you're serious about buying this house, and it's a good faith deposit that you do on the house. Those are all costs that are associated, and that has nothing to do with your down payment. Again, those are just third-party closing costs. So when you're looking to purchase a house, it is recommended that you do have, even if you're doing 100% financing, even if you're doing a program, you're still going to need some money to purchase a house. You're going to need money for an earnest money deposit. You need money for a home inspection. You're going to need money for an appraisal. Even if you're doing a program or even 100% financing, you're still going to need some money. So it's a general myth that, I'm buying a house, I can get into a program and I don't need any money. That's not the case. You're going to need some money.
Okay, awesome. Yes, definitely. Money to buy a house. We need it for sure. Okay, so you mentioned the difference between pre-qualification and pre-approval. Pre-qualification is basically, hi Bruce, I want to buy a house. What do you think about this situation that I'm in, and what do you need going forward? A pre-approval is that formal letter saying this person is ready to go. They can purchase up to this amount. So when you do the pre-approval, you're checking the person's credit. A lot of people are concerned that it will negatively affect their credit. Let's say they're not ready to buy. You find out when you run the credit, they're not in the position to buy at this moment. Will it negatively affect their credit further down the line?
And the answer to that is yes and no. And I'll say this. When it comes to doing a credit report, the credit bureaus, Equifax, TransUnion, and Experian, the number of inquiries does affect your credit rating. It's a very small portion. They will allow you, they being the credit bureaus I just named, will allow you up to 6 credit inquiries within a 6-month period before it negatively affects your score. Now, here's the thing. Let's say that you are contacting a lender to get pre-approved and you haven't had your credit pulled for 6 months with anybody else. That means you can go to another lender, maybe even a third lender, get a second or third opinion, and it's not going to affect your score. Now, for those viewers that are watching, you may have purchased a car recently. And a lot of times when you're buying a car, if you're financing, you'll see the little finance guy go back into this room or whatever the case may be. What they're doing is running your credit with multiple providers that they use to get you the best finance or to get them the best profit, whatever the case may be. And in some occasions, when you're buying a car, you may have 10 to 12 credit inquiries in that one day. Remember, 6 credit inquiries in a 6-month period. Bought a car, that's 12, sometimes 10 to 12 right there. So that's where you may see your score drop. Now, we do have an option of doing what is known as a soft credit pull. And there's a difference between the soft credit pull and a hard inquiry. Typically, anytime you apply for credit, that's going to be a hard inquiry. We do have some new software, our company, and when I say we, I mean our company in FM, where we can do a soft credit pull, and it will not show as an inquiry on your report. So the credit bureaus don't know that you have we've pulled a credit report, TransUnion, Equifax, or Experian. So that with that process or with that new technology we have, you can get a synopsis of what you qualify for credit-wise, see where you stand credit-wise without it showing as an inquiry.
Awesome. Awesome. Okay. This is all great information. I know there's a lot of people out there who are very grateful for all your advice and information. Last question. Somebody comes to you today or calls you today and they say, Bruce, I want to buy a house. I have got everything I need for a pre-approval. I've got my W-2s. I've got my income tax. I've got my bank statements, all of that. How long will it take from the time they talk to you to the time they can buy a home?
Okay. So this mainly depends on the client. Now, if we've come to this client that's well prepared, they're organized. That's the big thing. You're organized. You have all your documentation there, your W-2s, your pay stubs, your tax return, assets. They talk list today. Today is Tuesday. We're face to face or over the phone or whatever the case may be. We've done the application. I've called back, going over the numbers. Later on today or tomorrow, typically it's going to be about a 24-hour period. The client has forwarded the documentation needed. At that point, we get the automated approval and issue the approval letter. That time frame, depending on the client, we can do that same day, but definitely by 24 hours total. If they're organized and ready, we can get you done 24 hours or less, and in some cases the same day.
Awesome. And then from there, of course, that depends on the realtor and the specific situation with the house, home inspection, appraisal, all of that stuff. But it can be done in as little as 30 days or even less in some cases. But of course, like you said, it's very dependent on how ready somebody is with all of the information and how quickly they get back to you with all of the information that you need. So thank you, Bruce. I really appreciate you answering all our questions. If you need to reach out to Bruce, he's with NFM Lending, and I'll put his information at the bottom of the video. If you have any other questions about mortgages, lending, all of that stuff, or real estate in general, let me know, and I look forward to talking with you soon. Bye. Bye, Bruce.